Good afternoon, everybody. It is Thursday. We are almost there. We are almost there. Another really quiet day in the market, guys. Unless you're trading in the crypto space, it is another really, really quiet day in the market. We've seen that kind of all week this week. Maybe that's ahead of tomorrow morning's jobs report and, big funds, traders maybe just kind of sizing up their positions, getting ready for what they want, but volume is lackluster once again. VIX is pretty much unchanged for the day. I'm looking up here, trading 1349 right now. S&Ps have rallied back off of their lows. They were higher earlier, much higher, went down. They're up about 7 now, trading 6106 and change, or 6105 and change. But like I said, volume is very, very lackluster. Can everybody see and hear me okay? And again, happy Thursday. Happy Thursday. All right, excellent. Thank you, Mike. All right, so really, really important to everybody. As I just mentioned, we get the jobs number tomorrow morning. Now, we always get big eco data points, right, which can affect the market. This one, and we it seems like we've continuously said this for the last few months or so, because it seems like every one of these big data points, whether it's the jobs number or PCE, GDP, whatever it is, seems to feed into the Fed narrative and what they might do. And with the focus still being so squarely on what are rates doing and what is the dollar doing, tomorrow's jobs number could be really important, because remember, the Fed has a meeting in 2 weeks where they're still expected to lower rates by a quarter point. So that's pretty much baked into the marketplace right now, but it is what the trajectory is beyond that in 2025. Okay. That is what is really, really the big piece of the puzzle here. Powell came out, he spoke yesterday and sounded actually pretty dovish, but I would not doubt it if we see a really hot number tomorrow. What does hot mean? Hot means higher than expected. The reason being is, if you remember, 1 month ago, the number that we got, the jobs number of 12,000 or whatever it was the lowest number we had seen in a number of years. A lot of that was due to the hurricanes that we got, to the Boeing strike. So I think we're going to see a lot of give back this number because of that. And it'll be really, really interesting. Okay. It'll be really interesting to see how the market perceives it and to see what the initial move is, if it's a real hot number, as to what then happens afterwards once everybody knows what is in that number. How is it broken down? How much of the shortfall that we saw last month was attributed to those storms and to the Boeing strike? So get ready. Don't be complacent, guys. The market is very, very complacent right now, with VIX very low, volatility very low. Don't be complacent. These next few weeks, even though volumes may be light, volatility is still around. Okay? Volatility is still around. All right, folks, let's get on over here to allocation, risk allocation, reward to risk. How many of you think you're actually trading the right size? Okay? Whether it's 1 lots, 2 lots, 10 lots, maybe you're not basing it off of the amount of contracts you're trading, which you really shouldn't be. But how many of you think that you are really trading the appropriate size? Okay, Gilbert, excellent. Excellent. Because the last thing you want to do is not trade appropriately. Okay, whether it's too little or too much. Okay, and understanding and knowing if you are allocating the appropriate amount is imperative, guys, because if you don't do it, you will not ever really know how well you're doing. Okay, so as you're going to see here, it's all about consistency. Okay, do you know your risk? Okay, how do we figure out risk on credits, on debits? It's so imperative, and we try and guide you guys on every signal that we send out, right? We even put it in our signals. and we talk about what the risk is. We talk about risk allocation. Okay. I will tell you, even the guys down here trading, okay, I will tell you throughout my career of trading down here on the floor, trading up on the screens, that even seasoned traders sometimes get a little biased, sometimes sway away from what is appropriate or what the right allocation is. It doesn't work out, guys. Okay. It doesn't work out. It really doesn't. So, risk allocation and reward to risk. Okay. Risk allocation and reward to risk. We've got to know it. And I'll tell you what, even folks down here that are trading, some guys have been here for 20, 30 years, but some people down here, because everything is automated now, because everything that they do and everything we all do now is available to us at the push of a button, and we don't have to use our brains and we don't have to put pen to paper anymore like we used to. This can get lost in the shuffle, and you will pay the price if it gets lost in the shuffle. So let's take a look here, guys. This is a signal of ours. Okay, this is a typical signal of ours that you see here. Okay. Yeah, something good, something picking up over here. I like it. I like it. Okay. So as you can see, this particular spread, which this is a real trade. Yesterday, when we were looking at this here, we were talking about some hypothetical trades. This is a real position we have on. Okay. Vertical call spread. Now, what you will see here on every single one of our signals, this is our recommendation. This is our recommendation. It is not the Holy Grail. It is not etched in stone. This is our recommendation to trade 2 to 3% of the size of your portfolio. Now, when I say trade 2 to 3%, that's the risk you should take. So that's why it's imperative to understand, boy, it is getting loud down here. It is getting busy and loud down here, but I think a lot of it is just BSing and not actually trading. It is imperative to know the risk in your trade. Okay. So in this particular trade right here, VRT call spread that we bought yesterday, okay, you can see here it's a vertical because both options have the same expiration. Anytime you trade any type of strategy, guys, okay, any type of strategy, butterfly, iron condor, vertical, credit, debit, whatever it is, and the expirations are the same, okay, the expirations are the same, that's known as a vertical. Even a butterfly is a vertical. Even an iron condor is a vertical. Maybe combinations of verticals, okay? But in this particular one, we're saying buy this for $1.80 or less. When you have a position where all of the contracts, all of the strikes are in the same expiration, if you have a debit spread, that is your maximum risk. So in this case, this is a bullish spread. You want the stock to go up. Even if it goes to zero, 180 is our risk. $180 per spread is our risk, no matter what. Okay, now let's review kind of that 2 to 3% allocation. Okay, 2 to 3% allocation. First, as I started off with earlier, you have to be consistent. Okay, I don't care, guys, if you use 2%, 3%, 4%, you want to go to 5%, that's fine also. Okay, if you're comfortable with it, you got to find your comfort level. Just be consistent. Don't look at a particular trade and say, man, I really like this one better than that last one that I did. So instead of 2%, I'm going to double up on this one and I'm going to make this one 4% or vice versa. Do not do that. I am telling you, that is a recipe for disaster. Stay consistent. Are you always going to have a lot of shoulda, woulda, couldas? Yeah, that's trading. That's trading. Don't be a Monday morning quarterback. Stay consistent. Trade your size. So let's go through some dollar amounts here. What's up, Zora? How you doing? Okay, if you have a $5,000 account and you're trading 2 to 3% risk, you're going to allocate 100 to 150 bucks per spread. Now, it's always not going to come out to even money, to even dollars, right? 2% may not always be 100 bucks or, whatever it is. So just be as close as possible as you can. If you have a $10,000 account, it's going to be $200 to $300 risk. If you have a $25,000 account, $500 to $700 risk. Okay, that's based on 2 to 3%. Again, you want to trade at 4%, 5%, 1%? Great, have at it. Just stay consistent. Okay, does anybody have any questions on that before we move on? Before we move on to the appropriate sizing. Okay, and again, these are just guidelines. The reason that I guide to 2 to 3%, okay, if you think those of you that are in OpVol, and I think it's pretty much the same with Mike and with Charlie, okay, although Charlie's allocation is a little bit different on some of them. But if you think of it, when we get really busy, when we have a lot of positions on, okay, when there's lots of opportunity on, we could have at any one time, we could have upwards of 15 or 20 positions on at any one time. I mean, that's probably, the very high end. But if we have 15, 20 positions on and we're allocating 3%, okay, we're using up 60%. Okay. I typically don't want to go beyond 60%. I always want to have some dry powder. Why? Well, A, if the what hits the fan, okay, and B, more often than not, because we're being aggressive trading, you never know when that next opportunity is going to be there. And if there is something that is just such a really good opportunity, I want to have the dry powder to be able to trade it. Okay, does that make sense to everybody? Does that make sense? Consistency, folks, consistency. All right, Robert DB, I know you are so anxious to get back on that wheel. You've had a dry spell here. What is it, 3 days that you haven't won? Man, you must be like freaking out. So yeah, you had it. Today's word for the wheel is risk. It is risk. Keep it real easy and on point today. Okay, let's get those risk words up there in the chat for the wheel. We'll come back to that shortly here.
How's the strip go for?
I'm listening to what's going on here. There's a lot. I mean, the volume is not, I'm looking up on the board, volume is not a lot, but there's a lot of chatter going on here. There is a lot of chatter, guys. Okay, let's go back here. Now, all of you should have this. Okay? All of you should have this. If you don't, it is in the documents folder in every room. Okay? It is in the documents folder in every room. You should all have this reward to risk guideline. You are not going to find anything like this on the internet. If you go to YouTube or wherever and say, hey, how much should I trade? What should I, allocate to this particular strategy? You are not going to find this. This is something that we here at Prosper have put together. And this comes from our own experience of literally trading hundreds of thousands of trades, maybe millions, probably even millions at this point, hundreds of thousands of trades over the last 25 plus years. Okay. And what we have found to be the right reward to risk. Hey, Robert DB, $1.40 KMB. Thank you for the heads up there. That is a fantastic trade. Anybody else in OpVol selling KMB at $1.40? And I'm assuming there are no VRT fills on the partial exits yet. Okay, so anyway, let's take a look at this. What we have to remember, guys, okay, and what reward to risk is, what we have to remember, every trade you make, no matter, regardless of the type of trade, has some level of risk to it. Okay, could be this much risk, could be this much risk. Every trade you make. Gilbert, thank you very much. Outstanding. Love that. Love that. I'm assuming that KMB must have rallied. Actually, let's see. KMB must have just rallied back a little bit here. Oh, there it is. It's up 72 cents, getting right close to where? Where, folks, is KMB trading? It's getting close to what? Come on. Let me hear it. You're all part of the club. You're all part of the club. Price of our spread is going up because the stock is moving to our short strike. You got it. It is creeping right towards our short strike expiring tomorrow, just as planned. Excellent. Okay, back to our reward to risk here, guys. Every trade you make has some level of risk to it. It's incumbent upon us, well, it's incumbent upon me and Mike and Charlie to guide you guys, to teach you how to find what is the appropriate level of reward to risk. Because we don't ever want to get caught up with FOMO. FOMO meaning, oh man, I'm going to take this trade just because, boy, it looks like, MSTR is going to 12 gazillion tonight. Or, Intel got smacked. It's got to recover. And I see all this money piling into NVIDIA and all these trades piling into Tesla. You can never take a trade based on FOMO, guys. You have to know your reward to risk. And if the reward to risk is not there, if it is not at an appropriate level, as hard as it is, and it's human nature to want to be part of the action. If it's not there, take a pass. I promise you'll find something to trade that does have the appropriate level of reward to risk. It's easy for me to say that because I've been doing this for almost 35 years. Okay. But I promise you, FOMO is a trader's worst nightmare. Don't get caught up with it. Okay. So let's talk about
72 delta. I'll be at 22.70.
a typical, just basic call or put spread. Vertical call spread. Okay. Vertical meaning this. Things are on top of one another. Okay. This is what vertical means. If I look at vertical and I'm looking at my trading platform, which I'm going to do here in a second. Okay. Vertical means that one option is on top of the other in your platform, in your trading platform. So if I look at our VRT position, okay, here's our position. Here is our position. Okay. Our long strike is on top of our short strike. That's a vertical. All of the options are in the same, expiration. Wait, all that shouting behind you must be KMB trading, right? Yeah, these guys aren't trading KMB right now, unless they're taking the opposite side of what we're doing, which would be great because that would mean we're all filled. So vertical, all of the options are on top of one another. Now, we look for a reward to risk. Okay. We look for a reward to risk in a vertical spread without it being earnings, because earnings inherently there's a little bit more risk. So we're going to ask for a little bit more reward. We're looking for at least 2.5 to 1. At least 2.5 to 1 reward to risk. Most of the time we're getting in closer to 3 to 1, maybe 280 to 1. That means 2.5 to 1 for every dollar we're investing, for every dollar we're putting into a trade. We could potentially make 250 back. So let's go back to this VRT. Okay. In VRT, this happened to be a $7 wide call spread. Kind of odd, typically we're on the even numbers around, $5 increment, 10, 7.5, but this one happened to be a $7 wide increment. And we paid $1.80. How do we calculate our reward to risk on this? Well, max value is $7, right? Even if VRT is 200, 500, 1,000, whatever it might be at expiration, the most of this could ever be worth is $7. Okay, we paid $1.80. Okay, we paid $1.80. That means our maximum potential reward on this is 520. Okay, what is 520 divided by 180, everybody? Anybody? It's almost 2.9 to 1. Okay, it's almost 2.9 to 1. Okay, very good. There you go, Robert, Don. Okay, so that means for every dollar we're putting into this trade in VRT, we could make 290. Great. My reward to risk cheat sheet tells me we're looking for 2.5 to 1 or better. I'm going to do that trade. I'm going to do that trade. Okay. If it is earnings related and we're just using debit, call spread, put spread, okay, we're going to look for that 3 to 1. Again, if it's 2.98 to 1, does that mean we're not going to do it? No, we probably would. If it's 2.9 to 1, I'm not doing it. I'm not doing it. I'll find something better. Okay, I'll find something else that does return the appropriate reward to risk. Okay, so that is how we look at if we know a trade is opportunistic or not, if the probabilities are in our favor with the appropriate reward to risk. Now, before I identify what the reward to risk really means and what it's based off of, because we can fudge the numbers. We can make our reward to risk look great. We can get 5 to 1, 8 to 1, 12 to 1. Okay. But it's not going to be realistic. And I'll go into that in a moment. Let's look on the credit side of things. Okay. Let's look on the credit side of things. Okay. Now, debit, if I'm putting money out, if I'm lending money to you, if I'm giving you money, Zora, okay, I got to get a higher reward back. I got to get more money back. But if you're giving me money, I am willing to take less of a reward to risk. That's why you'll see on our credit spreads, we typically only look for close to 1 to 1, sometimes even a little bit less. Okay. Again, we want those odds in our favor. Trading is hard enough. If we don't get the appropriate odds, okay, you don't stand a chance. You really don't. Okay. So big difference between a debit and a credit spread in terms of reward to risk. Now, what do I mean by when I said, and you know what, I see a lot of you going back to Groucho here. So let me put that up here for a second. Meanwhile, in the last 2 minutes or so, S&P's just dropped 10 points. S&P's are now down 5 on the day. Not sure if anything just came out. VIX didn't really move. It pretty much stayed unchanged. Now we're down 6 points. Interesting. I will keep you guys up to date on what's going on, and if I hear of anything here. Okay. Trying to listen. There's a nice big put spread here. Okay, there's a nice big spread going on here. One big put spread being quoted. If I hear the strikes, I'll let everybody know. Okay, back to here. Yeah, down 7. It's down 14 points here, Kenny, in the last few minutes. Again, not sure if any news came out or that's just kind of the flow today. Could be just the flow today. Okay, what is our reward to risk based off of, guys? When we determine eight guys in a 105. Come on, everybody, really quick. 13 and 1 gets 14. Come on. That's how the broker divides it up. So he had 105 of these spreads. There were 8 people on the spread. So he's got his calculator out. I just told him what it was. 13 and one gets 14 if it's an equal split for everybody. Anyway, what is reward to risk based off of, guys? We have to have a common benchmark, right? We have to have a common baseline to figure out, okay? It's based off of the expected move. It's based off of the strikes using the expected move, with the short strike being at or near the end of the expected range. Okay, when I said that we could fudge the reward to risk, let me show you what I mean. Okay, in VRT here, guys. Okay, we'll just keep it in VRT. What if we used higher strikes instead? You know, we're still bullish. Okay, when we put the spread on yesterday, we targeted the 144 because that was the upper end of the expected move. Okay. But what if we look at it now and we want to buy, let's see, the 150, 160 call spread. Okay. The 150, 160 call spread. Boy, that's only trading a buck 05, something like that. Okay. 105. What is the reward to risk on that? Okay. What is the reward to risk on this, guys? Yes, final call it is. If I pay 105, let's just call it a buck. There you go, Sandip. Very good. We'll use $1 just to make it easy to calculate. 9-1. Boy, that looks unbelievable, right? Why am I trading something for 2.8 to 1 or 3 to 1 when I can get 9 to 1? Right? Kenny, this is 9 to 1 here, not 5 to 1. It's 9 to 1 because the maximum value is 10. We pay a buck. That means I can make 9 as I pay 1. Okay, so that looks great. Why is the reward to risk so high there? Why does this look so enticing? Boy, I want to trade this at 9 to 1. Boy, Gary does look like shit. Sorry, guys. One of the brokers here that's been here for 30 plus years. Oh boy, something's going on. He looks like he's been through the ringer here. Okay. Why is it like that, guys? Why is it like that? Really bad odds. Why are you're actually getting really good odds here, Derek, but it's really bad odds of what? It's really bad odds of what? Bad odds that the trade's going to work. Right? Here, we know the expected move on the upper end was 144. Here, we're looking at basically 10% higher than that 160. The odds of the stock getting there are so much lower. So much lower. Remember, we had 68% probability of that expected move getting to 144. Okay. The expected move was like $8 or so yesterday at the time. Could have been $9. Okay. Here, we're looking now, this is pricing in from 134 to 160, a move of $26, almost triple the expected move. That puts it, and I don't want to scare anybody away going into statistics or probabilities, that puts it into almost a 3 standard deviation move, or only a 1 or 2% chance of that hitting. That is why the reward to risk looks so good, because the probability of it working is so small. So that's why it is so incredibly important when we base these numbers, when we base these ratios, these reward to risk ratios, okay? That's why it is so important to have that benchmark, that we're measuring that against the expected move. Hopefully that makes sense for everybody. Hopefully you understand that. Again, this spreadsheet that you see right here, this is in the documents folder in every room. Okay, it's in every room. Okay, guys. Before we go to the wheel today, just want to let you know I won't be here tomorrow. Charlie Moon will be hosting tomorrow. So guest star tomorrow. I know Charlie's always great in here. All right, so let's get to the wheel here, guys. Not too bad on the wheel. Okay. Robert, I know you were in here super early today. Robert, you must be going through withdrawal because you haven't won in 3 days. Yay, Charlie, the legend. All right. All right. All right. Okay, guys, here we go. Let's give it a whirl. Let's give it a whirl here. Who are we going to end on? Kenny, AZ, Rick, McCarty, Rick Huffmeyer. Rick Huffmeyer, are you here today, Rick? Are you here today, Rick? You gotta be here to win, guys. Rick is in the house. Wonderful. Wonderful. Okay, Rick. Make sure you send me an email. Prosper Swag at Prosper. Man, I can't spell today. Trading.com. Send me an email with your mailing address, your size swag. We will get that out to you guys. Nicely done. All right, everybody. Appreciate you. Have a great night. Big jobs number tomorrow morning, and then get psyched for Charlie Moon tomorrow afternoon. Have a great night, everybody.